If you've been wondering whether you should invest your CPF savings, you are not alone. The CPF Investment Account lets you put your CPF money to work. But is it really worth it? Or could investing put your retirement savings at risk? Let's break it all down in this video so you'll know exactly what to do. Hi, I'm Fer from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. Now, let's talk about the CPF Investment Account. What is the CPF Investment Account, also known as the CPFIA? Firstly, you must know that your CPF Ordinary Account offers 2.5% guaranteed interest per annum, which is decent, but some people wonder if they can earn more. That's where the CPF Investment Account comes in. It allows you to invest your CPF savings in stocks, ETFs, unit trusts, and government bonds. You can then invest in all this via the CPF Investment Scheme, also known as the CPFIS. The goal should be to potentially earn higher returns than what CPF offers. But here's the thing, unlike the CPF interest rate, returns are not guaranteed. If your investments don't perform well, you could lose money instead of growing your savings. Okay, so you've decided to invest your CPF money despite getting free money from the government. The next question is, how do you open a CPF investment account? Well, not everyone can open a CPF investment account. Here's what you need. You need at least $20,000 in your CPF Ordinary Account. You need to be at least 18 years old, and you cannot be an undischarged bankrupt. You must also open your CPF IA with one of the three banks, either DBS, UOB, or OCBC. If you already have an account with one of these banks, you can apply online. Otherwise, you'll need to visit a branch. Once your account is set up, you can invest up to 35% of your ordinary account funds in stocks and 10% in gold investments. Okay, now before you rush into opening an account, let's talk about fees because not all banks charge the same rates. So which bank is best for the CPF investment account? Every CPF investment comes with fees, and choosing the right bank can help you save money. Let's now compare DBS, UOB, and OCBC. For transaction fees, whether you're buying or selling your investments, DBS charges $2.73 per 1,000 shares, max at $27.25. UOB charges you $2 per 1,000 shares with a max of $20. OCBC charges you $2.50 per 1,000 shares with a max of $25. For the quarterly service charges, DBS charges $2.18 per investment counter with a minimum of $5.45 per quarter. UOB charges $2 per counter, while OCBC charges $2 per counter as well. If you are interested to find out and compare the fees, do check out our blog post and I'll link it down in the description below. Well, if you've compared all the bank accounts, UOB has the lowest transaction and service fees, making it the most cost-effective for CPF IA users. But what if you already have a CPF IA with another bank? Should you switch? Well, if you had your CPF IA for a while, you might be wondering if it's worth switching to a cheaper bank. You should switch if you want to reduce the fees because switching to UOB could save you some money. You should also switch if you're looking for long-term cost savings, especially if you invest frequently. You shouldn't switch if you're comfortable with the bank that you're currently using, either because they have a good customer service or they have good digital banking platform. You shouldn't switch also if you don't trade often because the fee differences don't impact you that much. Okay, so you want to save on fees. How do you switch banks? Number 1, open a CPF IA with the new bank. And number 2, request a transfer from your current bank. So each bank has its own instructions to move your CPF investments. So make sure to check out their official transfer guides. I will link them down in the description below, so do check them out. Okay, before you make any move, let's talk about some key risks you need to know about before investing through the CPFIA. Number 1, investing comes with risk. Unlike CPF's guaranteed 2.5% interest, your investments could actually lose value. If you're risk averse, opening up a CPFIA might not be the best bet. Number 2, you can't actually invest all your CPF OA funds. Only 35% of your OA can be invested in stocks, ETFs, and unit trusts, while the 10% can be invested in gold-related assets. Returns are also not guaranteed. Unlike the CPF's stable and safe interest rates, your investments could fluctuate. If the market drops, you could end up with less than you started with. If you're unsure about investing, it's always a good idea to consult a financial advisor first. So, should you open a CPF investment account? If you're comfortable with risk and you want to grow your CPF savings, CPFIA could be a useful tool. But if you prefer CPF's guaranteed 2.5%, then not investing will be a safer choice. Let me know down in the comments below. Are you planning to open a CPFIA account or switch banks? If you enjoyed this video, don't forget to like, share and subscribe for more practical financial tips. Thanks for watching and I'll see you in the next video.